Welcome to Market Overtime. I'm Diane King Hall. Tariff policy has certainly taken a firm grip on day-to-day, tick-by-tick market activity. And with each new headline comes either uncertainty, volatility, or some see even opportunity. Our guest today certainly has strong thoughts on how the Trump administration has conducted its tariff policy so far. Joining us right now, we have Peter Schiff, Chief Economist and Global Strategist, Euro-Pacific Asset Management. Peter, thank you so much for joining us today. I want to start with this. I want to hear your thoughts on your expectations for a recession. I know you have some strong thoughts on this. You've posted on social media about this. Do you anticipate the U.S. will be in a full-scale recession this calendar year? And I want to hear your thoughts on why or why not.
Well, absolutely. I mean, first of all, I think we were in a recession, kind of a stealth recession, all of last year. And I think the reason that we didn't officially recognize it was because the numbers weren't accurate. But I think the voters felt it, which is why they elected Trump. But the recession that Trump inherited is already much worse and is going to get much worse as a result of these misguided tariffs. So this is going to be, I think, unless the tariffs are miraculously called off and Trump surrenders, but I don't know what the odds are of that. But
Peter,
assuming that he
ahead.
sticks to his guns, right, this is going to be the worst recession since the Great Depression. It may be worse than the Great Depression. It depends on the mistakes that we make during this recession. It'll certainly be worse than 2008, 2009, the Great Recession. And it's probably going to include a financial crisis that will be worse than the 2008 financial crisis.
But Peter, let me ask you this. When you framed last year as a stealth recession, I know there were certain sectors that were hit, but the job market really held up. So I don't think that's actually fair to characterize it that way for last year. Now, going forward this year, obviously there are certainly risks on the horizon. We have these draconian tariffs at the table, more than 100% for China, China hitting back with 84% for the U.S., and then this baseline tariff of 10% across the board. Then you also have the EU responding. Now, in terms of the expectation for a recession this year, there are more in the camp who are seeing those odds, increasing odds there. But projecting it as the worst since the Great Depression, or even, the GFC, that feels like a stretch. Can you expand upon why you see that, what indicators you're looking at?
Well, first of all, I was alone in forecasting the financial crisis of 2008 when everybody else thought, it was all blue skies as far as the eye could see. But just quickly on the jobs you're referring to. So all the jobs that we created last year were part-time jobs that went to people who could no longer pay their bills on one job. So they were moonlighting. So these were not jobs that people wanted. These were jobs that people were forced to take just to maintain a standard of living, which they couldn't even do because they were maxing out their credit cards, even though they had 2 or 3 jobs. But as far as why this recession is going to be so severe, so 100% of the tariffs are paid by American consumers to the extent that they can still afford to buy the imported products. So you're talking about 20, 30, 40, 50% or more increases in the cost of almost everything that Americans buy. And Americans are already struggling to pay the prices we've got now. So what's going to happen is that many Americans are just not going to buy stuff anymore. And so all those retail sales are going to evaporate because prices will be too high for Americans to afford. So there's going to be massive layoffs, bankruptcies, I think in the retail sector, a lot of defaults. Meanwhile, what's happening now is a mass exodus out of U.S. financial assets. That's why U.S. bonds are going down, and the dollar, as well as the stock market. So that's going to send interest rates soaring. So what's going to be particularly bad about this recession is that rates are going to go up and prices. So it's going to be an inflationary recession, not just stagflation, where interest rates go way up. So imagine now, mortgage rates go to 8, 9%, maybe higher, and you lose your job. And state governments are defaulting on their municipal bonds, which is why muni bonds are collapsing, because local tax revenues are going to implode. Because if people aren't shopping because the prices are too high, then they're not paying sales taxes. And when people lose their jobs, they're not paying income taxes. Our economy is completely dependent on imports. Without imports, the whole thing collapses. But it's not just the economy for the consumer, the debtors, the government, because the way we've been shifting a lot of our inflation from Main Street to Wall Street is we print money the government spends money, gives it to people, and then we take that money and we buy foreign products. So we send the world our inflation, our paper, and they send us all their stuff. And so we get all this stuff to buy that we didn't make. And because it was imported, we don't have a big increase in prices. Now our trading partners take those dollars that they earned and they buy our stocks, they buy our bonds. That gives us a high stock market and artificially low interest rates. All of that is being reversed. So all that inflation is going to leave Wall Street and land on Main Street. So this is going to decimate the middle class and the poor with rising prices, but decimate the rich with falling asset prices. It's the worst possible scenario for Americans.
Peter, sorry, I just want to jump in for a second because I do see what you're saying about the risk for higher prices as it affects Main Street, especially with related to the tariffs because we import so much. And I see what you're saying about asset classes. We're already seeing some destruction in terms of asset classes. We're already in a bear market with regard to the NASDAQ and Russell. We've been flirting with that with the S&P 500. But I want to push back on what you said with regard to the job market. There are more than 170 million people in the workforce. There is a chunk of that is working part-time for economic reasons. In other words, to your point, having to juggle multiple jobs, right? There's it's more than 4 million, closer to 5 million. So it's a sliver of that, and I think, the voices on that are loud. And obviously I feel for people who are in that situation. I've done that before, right? But one of the factors in the economy that has held up is the job market. Are you expecting that is where we will see the cracks first? Where are you expecting to see the cracks?
Well, it's going to be all over because, first of all, companies are going to be struggling to maintain profitability with much lower sales volumes. Because when you have to raise your prices by 30 or 40% or 50%, you're going to lose a lot of customers. So one of the ways they can try to stay in business is by laying off workers. And of course, they're not going to need as many workers because they don't have as many customers anymore because the customers can't afford to buy the products. See, a lot of our service sector economy is based on access to all these imports. But you take all those imports away, there's nothing left to service. So we're going to see widespread layoffs and a collapse in GDP like we've never seen before. I mean, this is actually going to be worse than the contraction during COVID, because during COVID, even though people weren't working, they were still spending, they were still shopping. Now they're going to stop shopping because there's nothing left to buy, because the shelves are going to be empty. So this whole consumer-based economy is going to implode. And we're not going to have access to credit anymore because the foreign countries that were supplying us with the goods that we didn't produce were also lending us the money that we didn't save. So we're going to be cut off from the world's suppliers and the world's lenders. And so it's decimation for the United States, but it's actually liberation for the rest of the world. Trump liberated the world from the burden of having to support our economy. That's why foreign markets are going to boom as the U.S. market busts. And you're going to see a lot of gains in the emerging markets all over the world as the world, finally no longer has to support the U.S. economy, which is what they've been doing all these years.
Okay, and then, Peter, I want to ask you this. You mentioned President Trump. He has argued that the Fed needs to cut rates. You are seeing increasing odds of the Fed cutting rates more than expected this year in terms of the sequence and number of times. What say you to that?
Well, one of the reasons that the economy is in so much trouble is because rates have been too low for too long. I mean, the reason we have massive trade deficits is not because foreign countries cheat or impose these high tariffs on us. It's because we don't save enough. We don't make the investments in capital to build the factories. And that's because our interest rates are too low. We need higher interest rates to encourage the savings to finance the capital investment. So if the Fed cuts interest rates, that's counterproductive to what Trump wants to accomplish. It makes it more difficult for us to reindustrialize, which of course we're not going to do anyway. We're not going to build factories. Foreigners aren't going to build factories here. We're going to have a massive recession. The budget deficit's going to skyrocket to maybe 3 or 4 trillion a year. We have to refinance 26 trillion of our $36 trillion debt over the next 4 years. There's no buyers for that. So the Fed is going to crank up the printing presses like never before. It's going to do massive quantitative easing. So it's going to send inflation through the roof. That's already elevated. It's going to go through the roof, and it's just going to make the situation worse. They're going to throw gasoline on that fire.
Well, okay, so I think that what the president is trying to do is to avoid that. in terms of the debt and the government spending, government's debt. It was a focal point of voters. What do you think President Trump's end game means to addressing this issue, to addressing the nation's debt load? He would argue that they're bringing in, now it's unclear if this is accurate. He says already these tariffs are bringing in, 2.5 or $2 billion a day. Unclear if that's actual, what the math is on that. But he argues that it would bring in revenue into the country and address the debt. What do you say?
No, because a lot of the money they think they're going to get from the tariffs, they're not going to collect it because the goods are going to stop coming into the country. And so there's not going to be any tariffs imposed. But to the extent that there are tariffs paid, they're going to be paid by Americans, by the middle class, by the poor. I mean, the reason that we went away from tariffs in 1913 was to tax the rich with the income tax, to let the middle class and the poor off the hook from having to pay the tariffs. But now Trump wants to clobber the middle class and American workers with tariffs on top of the income tax they're paying, on top of the payroll tax that they're paying, that didn't even exist back in 1913. So this is a massive tax hike, but the recession that we're going to create is going to end up worsening the deficits. But what's also going to worsen the deficit is rising interest rates. Yields are going to keep climbing. So the yield on a 10-year Treasury is going to go up, way up, not down. And so if we're going to try to refinance our debt, the interest burden on the debt that's exploding is going to be much higher. Look, gold is up about $110 so far today. It's at a record high. This is the most gold has ever gone up in a single day, right? This is not an accident. All the so-called experts said if we have tariffs, the dollar will go up. I was alone in predicting that it would go down. The dollar is crashing. The experts said if the economy weakened, we'd get lower interest rates. I said no, we'll get higher interest rates. That's what we're getting. We're getting a crashing dollar and soaring interest rates as we have a bear market in stocks. The Russell 2000 is already down 30%, right? That is the index that's most closely tied to the U.S. economy, because it's the U.S. economy that has the most to lose. The domestic economy is going to get decimated by these tariffs. And investors who stay the course, who hold on to their U.S. stocks, will get decimated, and their U.S. bonds, and their muni bonds. But gold stocks are about to explode, I think. I think these are going to be the greatest investment winners, because the gold companies are the big winners from this, because oil is now down to about $50 a barrel because the markets are pricing in massive recession. But gold is at record highs. The biggest expense of a gold company is oil. So most gold companies now are trading at 5 or 6 times earnings, and their earnings are exploding. So that is the investment opportunity of a lifetime. I've got a special report, the best way to buy gold, that you can get on my website at Europac.com. But this is a great opportunity for people to get into gold stocks.
What do you see as the worst case scenario and best case scenario, especially if there is, some people say there could be the potential of de-dollarization, but where can people go then?
Well, they are de-dollarizing. They're going to gold. That's why gold is so high. Retail investors are not buying gold. They've been selling gold, the whole rally from 2,000 to 3,000, retail sold. Retail investors have been selling their gold stocks for the past year. In fact, in the first quarter of this year, the GDX, which is an index of gold stocks, only had 1 day of inflows. Every other day, investors pulled money out. They did the exact wrong thing. What did they do when Trump won? They loaded up on U.S. stocks. They loaded up on the Russell 2000, and they're getting decimated. Because I said when Trump won that the real Trump trade was to sell U.S. stocks, because what Trump wanted to do was very bearish for the stock market, and he's doing it even worse than I thought he would. And so it's going to be an even bigger decline. But for the dollar, the worst thing that can happen is the Fed steps in and goes back to QE to bail out the economy, to bail out the bond market, to stop this coming financial crisis. Because if the Fed does that, the dollar's going to implode. So it could drop another 20, 30% very quickly, and that will add to all the prices, right? All of our import prices will be even more expensive, because not only do we have to pay the tariffs, but our dollars are going to be so much lower. So the prices are going to go up anyway because of the exchange rate. And then on top of that, we're going to have the tariffs. So basically, consumption in America is going to grind to a halt. right? People are going to stop spending. And if you have an economy that's predicated on people spending, and we've been financing it with debt, credit card debt is at an all-time record high, there's going to be massive defaults. Our entire banking system is insolvent. You know, in the stress test, the one thing that the Fed never tested for was stagflation. They never tested the banks in an environment where you have a recession, but interest rates go up. And the reason for that is that every single bank in this country will fail if we have a recession with rising interest rates. And that's exactly what we're going to have.
But the government probably wouldn't let that happen. I mean, we certainly saw that, especially when it came to the GFC, right? But let me ask you, I want to go back to your point about gold. I mean, you mentioned, obviously, that it's been hitting records. We've been seeing this flight to safety as well. Look, in terms of the positioning when it comes to gold, are you worried at all about it being overbought?
Not at all. Nobody owns it. Nobody owns it. You know, I watch a lot of these investment channels. They never talk about gold. They never talk about gold stocks. Nobody ever comes on to recommend gold stocks. This is the most unloved bull market in the history of gold. You know, in order for it to be overbought, somebody would have to buy. In fact, if you look at gold stock prices, they've never been this cheap, ever, you know, relative to the price of gold. Why is that? Because investors don't believe the rally, right? They think gold's going to crash. That's why silver is so cheap. They're not buying silver either. The only buyers are foreign central banks, and then maybe the Chinese or something like that. But the foreign central banks are like the insiders. They know that the dollar system is about to implode. That's why they're buying gold. So the public hasn't even joined the trade yet. Gold is going much higher. It could easily hit 3,500 this year, maybe 4,000, maybe much higher. But by the time the retail public wakes up, gold could be 5,000 or 6,000. These gold mining stocks could be 5 or 10 times their current price before the average retail investor even realizes that they went up and starts buying them. I mean, they've been sidetracked by Bitcoin and all that nonsense in crypto, or they've been buying the Mag 7. They have no idea what's going on, and they're missing out on the opportunity of a lifetime.
So beyond gold, though, are there any markets, any international markets or opportunities that you favor over the U.S., especially given the pessimism that it sounds like you have?
Well, all of them, because as the dollar collapses, that means other currencies rise. And so what that means is as Americans get poorer, the rest of the world gets richer, right? Because it's all about exchange rates. Now, the people in other countries can afford to buy all the products that countries used to ship to America, but that they no longer ship to America. You see, all the production doesn't stop. All the factories that are located outside the United States are going to keep on producing stuff. The difference is it's not going to be coming to America. So the rest of the world is going to get to enjoy the fruits of that labor. Meanwhile, in America, we're just going to have a bunch of paper that we print, but there's going to be nothing to buy because we don't have the factories. See, Donald Trump's got it backwards. We don't have the cards. They do. The consumer consumption is not the key. It's production. Supply is what creates the demand. All we have is demand and no supply. We can't do anything with that. We can't consume what we don't produce. But the rest of the world can easily consume what it does produce. They've been allowing us to consume it. That's going to stop.
Peter, let me ask you this. Critics often argue that your views are too pessimistic. Obviously, I can see, kind of your views in the context of the market action that we've been having recently with regard to the tariffs and the volatility around that. But over the years, many times we've continued to rally back from the brink, whether we go back to the GFC, the Great Financial Crisis, or the COVID pandemic. There are those who say you're perennially bearish. How do you respond to that?
Well, first of all, when I was forecasting the 2008 financial crisis, they kept calling me that. In fact, they nicknamed me Dr. Doom back in 2005, 2006 for predicting exactly what happened. And I used to say, look, I'm Dr. Reality. This is what's going to happen. Now, you're correct. The Federal Reserve has been able to paper over the problems by making them worse and kicking the can down the road. So the U.S. economy today is in much worse shape than it was going into the 2008 financial crisis. In fact, it's not even close. So we are in much worse shape. Now, the question is, will the Fed be able to pull another rabbit out of its hat and and kick the can down the road again. That's the bet you're making. But the problem is so much worse right now that if they try to go back to the quantitative easing drug, we overdose. We end up with hyperinflation. I would say that things have changed so much where they can no longer claim inflation is below 2%, so they have room to do QE. When they go back to QE and start cutting rates and try to monetize the debt that we got now, they're not going to get the reaction they got before. We're not going to buy ourselves more time. We're just going to seal our own fate. And everything I've been saying about the macro picture has been accurate. The experts have been wrong on everything except the stock market bubble got bigger, and they don't even know it's a bubble. And they don't even realize that everything the Fed did following the 2008 financial crisis, following COVID, everything was wrong. They made a deal with the devil to buy some short-term relief, and the devil is coming home to collect.
So, Peter, you're king for a day. What should the Fed be doing instead, then?
Well, they should have kept hiking rates. Rates are too low. In fact, they never got rates restrictive. That's why gold prices kept going up, because they were always too easy. That's why credit kept expanding. That's why the government kept going into debt. That's why household debt and credit card debt hit record highs, because interest rates were still too low. So the Fed never did what it needed to do to put the inflation genie back in the bottle. That's why it never got back in the bottle. And now it's going to be doing more damage than ever. So what I would do is I would immediately hike interest rates substantially and just let everything collapse, because that's what has to happen. It's going to happen anyway, but I would rather have asset prices fall and debts go into default than create hyperinflation, which is where the Fed is taking us.
So are you saying that we're essentially in like an just about everything bubble?
Yes, of course, everything was in a bubble. And that's why we had these trade deficits. It was a function of our own bubble. It's not because foreigners were cheating. The reason we have these deficits, that's the symptom of the underlying problems in our economy. We're trying to blame others for our problems that we created, and we're pointing to the symptom and saying that's the problem. No, the problem is our artificially low interest rates and the fact that it's encouraged excess consumption and discouraged savings and investments. And so we don't have the factories anymore. We don't have the infrastructure. We don't have the supply chains. The Fed has inflated the mother of all bubble economies. And Donald Trump just pricked it.
Okay, so is America drunk on debt from your perspective?
We're drunk on debt and imports, and we're about to go cold turkey.
Okay, and then I want to ask you, while we still have time with you, the levels that you're looking for. Obviously, you're very bullish on gold, but some, call Bitcoin, a gold proxy. I want to hear what levels that you're looking for with regard to gold, Bitcoin, and even the S&P 500 by year end.
Well, the people that call Bitcoin a gold proxy don't understand gold or Bitcoin. Bitcoin is just fool's gold at best. It's nothing. But it's a highly speculative digital token, and I think it's going down. I mean, it's already 30% off its highs, so it's not at record highs like gold. It doesn't trade anything like gold. So if you want to buy gold, buy gold. If you want to gamble, and you can gamble with Bitcoin, I just think it's a bad bet. I think the market's going down, especially if Trump sticks to his guns, and the tariffs remain. Now, if Trump finds some way to save face and claim victory out of defeat and calls off all the tariffs, yeah, we could have a big rally. But I would imagine that rally would be another opportunity to sell, because I don't know that we could put all these, worms back in the bottle here that we opened. I think the bear market has started, and any rally from here is a bear market rally and an opportunity to get out. But, if we stay the course, we're just going to keep falling. I mean, we could easily be down 50% in the major averages, before maybe they buckle and the Fed, cranks up the presses.
Peter, I want to ask you one quick question. You said if the market rallies. At this moment, as we're speaking, we are seeing a big rally take shape right here. And this is following some reports that we're seeing that President Trump just announced a 90-day pause for some countries with regard to tariffs. And that is with regard to tariffs on non-retaliating countries. This according to CNBC. What's your thoughts on that?
Yeah, I mean, as I said, that may be the first sign of surrender. because the tariffs are bad for America. And so the only reason that the markets weren't down a lot more was because people were hoping that Trump would call them off, right? So, and now he's saying we're going to have a pause. Well, there's still a lot of uncertainty because maybe they're going to be unpaused. But, yes, I mean, that's the only thing that rallies the market, but I would sell into the rally because U.S. stocks were overvalued before the trade war. With the trade war, I mean, they're even more overvalued. But they're expensive, and I think the trend to get out of the U.S. is still there. I mean, who knows, what's going to happen? And even if they pause them, I mean, what level are they going to come back at? Are they going to be somewhat lower?
But Peter, do I hear a little bit of softening in your voice in reaction to what we're hearing with regard to this 90-day pause? Because there was some thinking that this is just a negotiating tactic.
Yeah, look, it's most likely that you should sell into the rally because Trump seems committed to this destructive course because he introduced it with a lot of fanfare, Liberation Day, how great it's going to be, how wonderful these tariffs are. So it's hard to believe that he's just going to walk away from that completely and get rid of all the tariffs. So any tariffs we have are going to be destructive to the U.S. economy. And we're not going to bring back manufacturing. When he was president the first time, he kept claiming that manufacturing came back, but it didn't. We lost manufacturing, and the trade deficits got bigger. They hit record highs on Trump's first term, and so he bragged about doing things that he didn't do in the first term, and he's not going to get them done this term either.
And then, Peter, I want to ask you. This is kind of a thought on. Let's say there's a young investor watching this right now, and they're trying to make sense of everything that's happening with regard to tariffs. They watch the sell-off, watching some of a rally here. If you're managing money for a young investor today or giving them advice, how would you advise them for the next decade for success?
Well, for the young investors, as I said, I think buying gold mining stocks is, I think, the best way to really supercharge your portfolio, because you have an opportunity to buy an asset class that is so unloved and unowned, out of favor and cheap. And you're talking about, lifetime low valuation. When you're in the biggest bull market in gold in our lifetimes, yet nobody owns the gold mining stocks. At a normal bull market, the gold mining stocks are leading gold. Now, a lot of these stocks are cheaper than they were 10 years ago. Gold so far in the last 25 years, this decade, is up, massively. It's up, 10x. Gold was under 300, and now it's over 3,000. The S&P 500 is down over 60%, maybe 65 or 70% now. I haven't checked, priced in gold. So gold is the best performing asset, relative to stocks or bonds or, real estate in the U.S., and that's going to continue. But none of that is factored into the gold mining stocks that own all the gold that's still in the ground. And they are going to make a fortune mining that gold and selling it.
Okay. Well, Peter, thank you so much for your insight and perspective today. And obviously, for any young investors, obviously you need to manage your own risk tolerance and know your situation, what works for you. That's Peter Schiff, Chief Economist and Global Strategist, Euro Pacific Asset Management. We appreciate your time today, Peter. That's it for this episode of Market Overtime. You got it. Be sure to like and subscribe to our YouTube channel for plenty more from Schwab Network. I'm Diane King Hall. Thank you again for tuning in to this episode of Market Overtime.